A stock market crash is a sudden and dramatic decline in stock prices across a significant portion of the market. This free fall in prices is usually driven by panic selling as investors rush to offload their holdings in fear of further losses. Crashes are characterized by their speed and severity, often wiping out billions, even trillions of dollars in market value in a matter of days or even hours. They can leave investors reeling, erode confidence in the financial system, and have long-lasting impacts on the broader economy. Imagine a crowded theater. Someone yells fire. Panic ensues as everyone rushes for the exits simultaneously. This chaos is a fitting analogy for a stock market crash. The trigger for the panic can vary: an unexpected economic event, a bursting asset bubble, a geopolitical crisis, or even just a shift in investor sentiment. What matters is the collective response. A herd mentality takes over and rational decision-making gives way to fear and uncertainty. The consequences of a crash can be devastating. Individuals see their retirement savings evaporate, businesses struggle to secure funding, and the overall economy can plunge into recession. The psychological impact is equally profound, as the fear and uncertainty generated by a crash can linger for years, making investors hesitant to re-enter the market and hindering economic recovery. Understanding the causes and consequences of stock market crashes is essential for any investor or anyone interested in the workings of the global economy. By learning from the past and understanding the factors that contribute to these events, we can better prepare for the future and navigate the market's inherent volatility. While predicting the exact timing and magnitude of a stock market crash is nearly impossible, certain indicators often precede these events, like warning sirens. Recognizing these red flags is crucial for investors seeking to mitigate risk and make informed decisions. One such indicator is the formation of asset bubbles. These occur when the price of an asset, such as stocks, real estate, or even cryptocurrencies, becomes significantly overvalued compared to its underlying worth. This disconnect is often driven by speculation, hype, and a fear of missing out mentality, leading to unsustainable price growth. Another warning sign is excessive leverage in the financial system. When investors borrow heavily to purchase assets, it amplifies their potential gains but also magnifies their losses. A sudden market downturn can trigger a cascade of margin calls, forcing investors to sell assets to cover their debts, further accelerating the downward spiral. This domino effect can spread rapidly throughout the financial system, leading to a full-blown crash. Keep an eye on economic indicators like inflation, interest rates, and economic growth. High inflation, rising interest rates, and slowing economic growth can all contribute to a decline in corporate profits and investor confidence, making a market correction or crash more likely. Similarly, geopolitical instability, unexpected global events, and changes in government policies can also create uncertainty and trigger a flight to safety, leading to a sell-off in the stock market. By closely monitoring these economic and market indicators, investors can gain valuable insights into the overall health of the market and potential risks on the horizon. While these warning signs don't guarantee a crash is imminent, they serve as a reminder that market downturns are a natural part of the economic cycle and that preparation and risk management are crucial for long-term investment success. The stock market, like a ship sailing through stormy seas, is no stranger to periods of turbulence and upheaval. Since 1950, the market has weathered numerous crashes and corrections, each leaving its mark on the financial landscape and shaping investor behavior for years to come. Understanding these historical events is crucial for gaining perspective on the cyclical nature of markets and recognizing the patterns that often precede major downturns. One notable example is the bear market of 1973 to 1974, triggered by an oil embargo by OPEC nations. This event sent shockwaves through the global economy, leading to soaring inflation, economic stagnation, and a prolonged period of stock market decline. The Dow Jones Industrial Average, a key market benchmark, plummeted by over 45%, wiping out a significant portion of investor wealth. The early 1980s saw another period of market turmoil, fueled by high inflation, rising interest rates, and fears of a recession. The Federal Reserve's aggressive monetary policy tightening, while necessary to combat inflation, contributed to a sharp decline in stock prices. The market eventually recovered, but the experience served as a stark reminder of the powerful influence of macroeconomic factors on market performance. These historical examples highlight the importance of understanding the interplay between economic conditions, investor sentiment, and market valuations. While each crash has its own unique set of triggers and consequences, they all share common threads: periods of excessive speculation, overvaluation of assets, and a breakdown in investor confidence. By studying these past events, we can learn valuable lessons about the drivers of market volatility and the importance of disciplined investing strategies. Section 4, Black Monday, the crash of 1987. October 19th, 1987, a date forever etched in financial history as Black Monday, witnessed the largest one-day percentage drop in the Dow Jones Industrial Average. The market plummeted by over 22%, erasing a staggering $500 billion in market value in a single trading session. The speed and ferocity of the crash sent shockwaves across the globe, raising fears of a global financial meltdown. The precise causes of Black Monday are still debated, but a confluence of factors contributed to the panic. Program trading, a then new technology that allowed for the automated buying and selling of stocks based on preset conditions, played a significant role. As the market began to decline, these programs triggered a wave of automatic selling, exacerbating the downward pressure. Adding to the turmoil were concerns about rising interest rates, a growing US trade deficit, and geopolitical tensions. These factors had been brewing for months, creating an environment ripe for a correction. However, the trigger for the crash remains elusive, a stark reminder of the unpredictable nature of markets and the speed at which sentiment can shift from greed to fear. Despite the initial panic, the market recovered relatively quickly. The Federal Reserve, learning from past mistakes, acted swiftly to provide liquidity to the financial system and restore confidence. Interest rates were lowered and banks were encouraged to lend freely. These measures helped to prevent a deeper recession and paved the way for a gradual market recovery. Black Monday served as a wake-up call for regulators and investors alike, highlighting the potential dangers of automated trading systems and the importance of market liquidity. It also underscored the critical role of central banks in stabilizing markets during times of crisis. Section 5. Dot-com bubble. The rise and fall of tech stocks. The late 1990s witnessed the phenomenal rise of the internet and the birth of a new era of technological innovation. This digital revolution ignited investor enthusiasm, fueling an unprecedented surge in the stock prices of technology companies. The Nasdaq Composite Index, heavily weighted towards tech stocks, soared to dizzying heights, minting millionaires seemingly overnight. However, this exuberance masked a dangerous disconnect between stock valuations and underlying fundamentals. Many dot-com companies, despite having little to no profits, were valued at astronomical levels, based purely on their online presence and future potential. This speculative frenzy created an unsustainable bubble driven by hype, a fear of missing out, and a belief that the internet had fundamentally changed the rules of business. The bubble finally burst in early 2000, as investors began to question the lofty valuations of tech companies and the sustainability of their business models. The market started to unravel. The Nasdaq, once a symbol of the tech boom, went into freefall, ultimately losing over 75% of its value from its peak in March 2000 to its trough in October 2002. The collapse of the dot-com bubble had a profound impact on the economy. Many tech companies, once hailed as pioneers of a new era, went bankrupt, leaving investors with worthless stock certificates. The economic fallout was widespread, leading to job losses, a decline in consumer spending, and a recession. The dot-com crash served as a harsh reminder that even in the face of transformative technological advancements, the basic principles of investing, sound business models, realistic valuations, and prudent risk management remain paramount. It also highlighted the dangers of herd mentality and the importance of independent analysis in making investment decisions. If you found this analysis insightful, please like the video, leave a comment below, and subscribe to our channel for more in-depth content on financial history and market trends.